Hello, I am Annette Thompson with Bremer Investments. A lot of times, the cost of health insurance is the Achilles heel to your retirement financial plan. This is especially true if you want to retire before age 65, which is when Medicare eligibility begins. Retirees who need health insurance before age 65 can use either COBRA, which is the continuation of health care coverage through an employer, or the Affordable Care Act health insurance. However, both of these options can wind up breaking your budget. But through strategic income planning, the cost of health insurance prior to age 65 can be lowered through available tax credits. The trick is understanding the complexities of the law. Financial advisor Ross Olson will walk through an illustration of how to be strategic with your investment resources.
To understand the power of these tax credits, let's use a hypothetical example of a couple, John and Jane. A few facts about them. They are married, filing jointly. John and Jane are both 62 years old and recently retired. Their lifestyle requires an annual income of $80,000. They need health insurance through the Affordable Care Act for 3 more years, until John and Jane are 65 years old. So they start shopping plans. Their financial assets include $200,000 in money market and CDs, $600,000 in traditional IRAs, and $200,000 in Roth IRAs. Social Security for the two of them is $40,000 combined. They've decided that in addition to their Social Security, they're going to take $48,000 from their traditional IRA, but after tax it will be $40,000. This, along with their Social Security, will total $80,000, completing their annual income needs. However, in order to qualify for tax credits, their modified adjusted gross income cannot exceed 400% of the federal poverty limit, or $69,680. Their income would exceed that limit. As a result, they will not qualify for any tax credits and will pay the full cost of the Affordable Care Act plan. Looking at available mid-tiered plans, the average monthly premium is $3,120 or $37,440 per year. One can see quickly how this would ruin many budgets. Their healthcare costs would likely be their single biggest expense. They either must amend their lifestyle or take more money out of their retirement accounts, which may weaken their long-term plan. Now, let's assume instead of taking the $40,000 from their traditional IRA, John and Jane instead take it from their Roth IRA. Qualified withdrawals from Roth IRAs are free from income tax. As a result, John and Jane would still have $80,000 of income, with $40,000 from Social Security and $40,000 from their Roth IRA. In this case, when we rerun the healthcare plans, they now would receive a monthly tax credit of $2,751. This means their out-of-pocket costs for the same plan would be $369 per month. This is an annual savings of $33,012. Over the 3 years, John and Jane must wait until Medicare is activated. This equals more than $99,000 in savings.
Simply being strategic about where John and Jane derive their income changed the cost of their health insurance by thousands of dollars per year. These are savings that can now be used to increase their quality of retirement life or even adding to the value of their long-term legacy. Retirement financial plan strategies can be wide-ranging and varied. It is vitally important that as you approach retirement, you have conversations with your financial advisor on how best to structure your income before you turn 65, not only to meet your budgetary needs, but to also maximize available tax credits. Thank you for watching, and be sure to check out the other videos in our investment series.